The best-selling author, Dave Whitburn, returns today. He's a former lawyer, ex-Deloitte and Russell McVeigh. He started with putting a minor dwelling on the back of a section, and his latest development is 74 properties in West Auckland. Dave was the president of the Property Investor Association, and is a lifetime member of the Wealth Mentor Group. David, what is the biggest challenge for the property market over the next 6 months?
There are a few challenges. I think it's the uncertainty, the uncertain environment. There are a number of companies that are laying off people, lowering the available hours, and just some of the pressures we've unwound from that unprecedented money printing as well. So there are some uncertain times. The economy has slipped into a recession again in New Zealand. So it's just navigating that and keeping through to the fundamentals. That's going to be really important.
What should we be looking out for?
Some of it's just making sure that things stack, because we still want to move forward. We don't want to be dependent on the governments to look after us. That's a pretty suboptimal result. So we've got to make sure that we're striving for things like getting cash flow positive properties. With the debt to income ratios that were put in by the Reserve Bank last year, they'll actually have some real meaning and some cut through as interest rates become lower.
A lot of people say that positive cash flow is not possible in this current market.
Yeah, why have I been able to do it several times and repeating it there? I know that you go, well, you're a professional investor. It's your job, so to speak. It's what you do all the time. Well, you've just got to put in the work. You've got to associate and network with those that have those skills. By connecting with experience, you too can get out of that mindset that you can't do it. Be a can, not a can't. There's a crucial difference in doing that.
Are you seeing any property trends right now?
It's a great question there. Some of them are also things like Auckland, where the country's economic hub, which has over a third of the nation's population. It's a popular city. It's harder to get positive cash flow in it, so you've got to get some quite innovative strategies for doing that. These aren't just your stock standard house or just a brand new build. There's, obviously I'd love to tell you to buy all of my developments that are new builds, but the cash flow is just not high enough from them. So we've got to think a bit harder. We've got to actually create the deal. So sometimes that might mean a multi-income strategy. Sometimes it might be a relocate and a sleep out. Sometimes it might be an up and under, where we've got a house and we're lifting it up and building underneath it. It might be that we need to remove the house, perhaps have a duplex or a triplex, some kind of efficient plan there to bring that to the site. It might mean that we've just got to negotiate that a little bit harder to make things happen. Otherwise, we might not have to be in Auckland or a major centre. We might have to look at some of the regional cash flow where the capital growth rates aren't actually as dissimilar to Auckland as you might think. And with the Auckland Unitary Plan coming in, there is increased supply of property. So potentially, as the economic laws of supply and demand take place, maybe the growth rate of Auckland might not be absolutely everything that it's been in the past. So, and there's nothing wrong with a bit of diversification. So looking at some of the regions to getting those cash flow positive properties, I think that's really important.
What is the best piece of investing advice you've ever received?
Love how you put me on the spot, Blandon, but that's what friends are for. And I think the best advice is probably from my late grandmother, which is just invest and prosper. What she means by that, invest and prosper, is take action, do it. Don't be scared. Don't think that it's too hard, or don't think I can't do that, or it's not right, I don't deserve this. It means that you need to do it. Take that plunge, be an investor there. Don't be afraid to actually make a mistake. There are so many great people on the way that will help you manage those risks. Do it, be committed to it. And that's why I named the my book that Penguin Random House published me, Invest and Prosper with Property.
You must have set yourself some lofty goals when you were younger.
I believe that you only live once, so you owe it to yourself to make it the best life possible. Life's great. There's so many good things out of there as well. We're in a beautiful country, one of the most beautiful countries in the world, but mind you, probably only traveled to a quarter of them. So it's just that it's pretty fantastic here. We've got a pretty good climate. It's not too cold. It's not too hot. And with the sea, the ocean, the beaches, the parks, the sports, it's just so much fun to do. So to be able to maximize your time doing that, sometimes you have to have some better choice, because sometimes I realized that I didn't want to be a professional servant working 50 plus hours a week in an office, even though it's revered by many. That's just not for me. That's not to say for many colleagues and family members that are in these amazing buildings and firms that it's not for them. But I need to get out and about, need to meet, talk with people to do it, and I was able to realize that you can actually replace your cash flow from working as as a leading lawyer or accountant through property, but it takes you time to do it. You're not going to do it in a day. It's going to take you time to do it. But if you make considered effort, you can do that. So the goals that I set would be around amounts of cash flow, passive cash flow. That's income you don't need to work for. So that's the surplus cash flow there. So after taking away interest, repairs and maintenance and operating expenditure, once those things are done and covered for, that's the leftovers there for you after taxes as well. That's what I mean by having passive cash flow. And by having that passive cash flow, you can have some pretty cool choices in life. It takes a lot of pressure off there. For some, they get frustrated about the school and education systems. That's not political, but it goes over whether national or Labour-led governments. And for many, they want to put their kids into private schools to give them the best education possible that they feel that they're not getting through state schools, and that's great. That's something there to do. Something I've done and finding that that's working really well for me. Might be that you want to have better holidays. Might mean that you want to do more things there for your church, your community group, whatever. So there are so many reasons to have that extra cash flow to do it. And I mentioned this a few times before, though, but by having positive cash flow, it immunises you against any adverse effects in the market there or something that comes up.
Some people set goals like 10 properties in 10 years.
I might own 10 storage sheds just out of Cebu in the Philippines that cost me 2,000 New Zealand dollars. Oh, I've got 10 properties there. Maybe I own 100 there. Whoop-de-doo. Or do I own 10 of the Vero Tower in Shortland Street, that massive floor-plate and multi-stories it's got?
That'll be nice.
Is it really the number of properties? Exactly. Is it really the number of properties, or is it the quality of the cash flow and the equity that it creates?
Did you have a 10-year goal?
No, my goal was always around cash flow and equity. The reason, so the properties are only building blocks along the way. Basically, I'm trying to build a bridge to get from one side of the harbour to the other. So I have to get to the destination. So it's the cash flow and equity that real. In that sense, the properties aren't fully relevant. It's not an emotional thing. It's an investment. So I'm trying to just get units of cash flow and equity. Now, it'd just be a function of it there to get my cash flow up. I had in my strategy to have the property with a big backyard. So if this were to be a section and the house is here at the front, if I've got a backyard, well, hey, can I build one house on it, two houses on it? And what kind of cash flow and equity gain will that do? Because I'm going to make sure that I have my strategy in place where I'm buying them well. I'm not buying them below value, no problem. I'll buy them at retail happily because I know I've got a growth strategy and I can add value to it on the backyard, and I can get the cash flow from along the way whilst the equity's there. And then, of course, time is the other factor. Time gives you growth in rents and growth in house prices. Usually, obviously, in the short term, you can't even have negative equity growth there. You seldom see negative rental growth, but it's possible. So you just have to be mindful of that in your time frame. I do my numbers on 10 years. Over that, it gets a little bit tricky to do the assumptions. Get horrifically inaccurate there as well. Is it a 4% growth rate per annum? Is it an 8% growth rate per annum? Some people get a bit excited and put in 12% growth rates per annum, but we're not trying to be Duval-esque here. We're just trying to be sensible and give cold hard facts. And I think there's something there that's that you can tone it down and be a little conservative in your numbers, and if that helps you outperform your goals, great.
What advice can you give to first home buyers right now?
I don't believe that you should buy your first home until you've bought at least one rental property. And I didn't. I had a number of rental properties before I bought my first home. Why? It's actually better for you to do it. And why would you not have something there that pays you to own it, so then you can generate a deposit, because you've got other people there via your tenants there that are doing it, paying the market rent there, just charging that and your OPEX there. So they're helping you to save a deposit. I find it harder to save without, so it's better to get other people to do the saving for you. And then you're getting the equity growth from doing that. So is it actually a defective strategy to buy your first home as your first purchase? That's a pretty cruel way of doing it, and it's not the con thing. But I'd argue for me, it's a defective strategy, and I don't feel that I would have got the success I had if I tied up all the capital in it. I think it can be quite wealth eroding to buy your first home at there as well. It's one of the things that I think set apart many people by not having their first purchase at home. It's a mistake that many people unfortunately have made, and it's only until they look back, if they actually care to do so, which is hardly anyone, about 20 years later, and go, oh, I left a few million on the table by making that mistake and buying my home, because when you've bought your home, you do your damnedest to try to pay the debt down. So by doing that, you're not focusing on productive investments, the property investments there, when you're trying to build your cash flow up and build your asset base. It creates a natural and emotional barrier there to try to defend it there as well. So I know I've pulled apart your question there as well, but I strongly prefer people to not buy their first home. It's fine renting as well. It's a lot cheaper to rent than to own your home. It's only if you get worried, want to set down roots as well. So I really feel that people need to prioritise their own financial and their family's financial future, and that means investing before home buying.
And that is a very good advice, I believe, and that is definitely something.
Do you agree though?
Well, I live your advice. I have,
thank you.
I've got a few million of debt, but I don't have own occupied. So,
you legend. And why would you? And a number of other really, really successful people will do the same thing, because you unpack the secrets there as well. You can have an amazing house by not tying up all that wealth to do it. So I salute you. I don't know.
Yeah,
awesome,
I think right now, if in the current market is, interest rate are pretty high. So if you wanted to buy the same place versus renting, you're getting a much better deal by renting for the next couple of years when interest rate, closer to 7. Because when I needed to upgrade, it was a much bigger, the interest repayments were much bigger. So it wouldn't make sense to get another $1 million debt on the own occupied.
It doesn't. It might make sense as the interest rates keep going lower and lower. At some point, it'll be actually cheaper to rent. But hey, if it was get back to that 2.99% for 5 years again, like we had in early 2021, that would be pretty cool.
If you were looking to sell a house, what would make that more appealing to sell right now?
Keeping the street appeal there as well. It cracked me up seeing some properties last week that had the letterbox on a little bit of a land. That's always a good start. Then having the front door with a bit of mould and lichen on, peel and paint, that's always great. But some of the bigger ticket items are things like your kitchen, your bathroom there. So you don't want your property disheveled, because that's going to be a problem. It turns off many of the homeowners, because so many of them just want it done. They don't have the time, money, budget, or the vision to see what it's like. So you can get a bit of a punishing if you have a property that's poorly presented. Overpricing is an issue as well. The auctions are an interesting way of doing it. There again, I still maintain that suits the agents. I think they're fantastic in boom markets, but in this is the downturn phase of a property cycle. Possibly late downturn phase, but I'm not convinced that that's the best strategy. Often not getting the best buyers, and it puts many of the vendors under quite a bit of pressure to sell. It's just a more convenient way for agents to do things in terms of a dollar per hour on time recovery technique, and then the perception that's hey, look at all this marketing investment that's done. So I probably wouldn't sell by auction. I'd get an agent that's a negotiator, not just a processor that takes deals. And I would make sure that they're holding it to account, not a newbie agent in this market, an experienced agent that is a negotiator that's going to work hard for you to do it. But maybe price by negotiation with said date of sale might be a good strategy as well. That'll change soon when the market picks up. Options will become a really good strategy again. But please, when selling properties, don't leave them disheveled. Don't have your tenants being obstacles, and make sure that you've looked after them. Same out, be respectful for them, show some manaki there as well. Give them the respect that they deserve there. If you're running open homes, you're invading their home there, so cut some deal with them.
Yeah.
Maybe a good behaviour bond, give them a few $100, $1,000, or whatever it needs to be to make sure that process is smooth. It's pretty scary for them that they're going to be potentially losing their home.
That's a very interesting perspective around the method of sale is actually what would attract more buyers, and I think that is definitely a view of someone that is have a lot of experience in the market.
Done a few to know they've well been lucky enough to have developed or project managed over 700 dwellings, so seen all sorts along the way, and success stories there. And of course there'll be some success stories with auctions now, and of course there'll be some success stories with standard negotiation and booms too.